Welcome to the Strategic Treasurer Podcast, your source for interesting Treasury news in your car, at the gym, or wherever you decide to tune in.
Good day, and thank you for joining us today. I'm Isaac, and I am joined by Craig Jeffery, Managing Partner, and our fearless leader here at Strategic Treasurer. Craig, thank you so much for walking the 20 steps from your office to our filming alcove to be with us.
It's my pleasure, and it helped me reach my step count for the day.
So, the topic of today is Treasury technology, chiefly areas of innovation that treasurers are focusing on in 2018. So to begin, before we delve in too far, Craig, the majority of these insights are derived from the recent survey, the Treasury Perspective survey that we conducted with TD Bank. Would you mind giving us an overview of what that survey covered in its entirety?
Sure. There was several hundred questions on there. It's a long survey with a good deal of content, but the Treasury Perspective survey, this is what it's called. It covers the sentiment, the practices, the perspectives across 4 domains. The first domain is economic sentiment. What are people thinking about with regards to the global economy, the local economy, trends, changes, activities with regard to everything from tax reform to general development in the market. The second has to do with capital markets, entities, availability, and expectations for access to capital domestically and internationally. The third area we delve in is with regard to Treasury operations. What are people doing, planning on doing, where are they spending their money, where they're paying attention to. And fourth, we touch on that exciting topic, regulations. And the reason we touch on regulations is it has such a significant impact on Treasury groups in the last 4 or 5 years, and really since the financial crisis began, regulations began rolling out. So we wanted to see, how are people feeling about the economy? What are their plans to spend, to invest, to bring capital? What is their view on access to capital? How can that vary by size of company? And then looking at Treasury operation and regulation. So we wanted to gauge the practices, the perspectives, the plans. And so we asked many corporations, but also a significant number of banks across different geographies, different industries, and so we can merge some of those together. And that gave us a lot of basis for additional analysis, specific insight, and then some additional synthesis of what we see in the market.
Yeah, and with 300 respondents from all of those industries combined, that'll certainly be a staple of our research for the years to come. So, 4 sections of that survey. Chiefly, though, today we'll be looking at the Treasury operations section. That's where the majority of the technology-oriented questions were derived from. So let us go in. To begin with, APIs. So one of the key findings from the survey was that when asked about APIs versus blockchain with regards to payment operations, a majority of corporates and banks as well found APIs to be more significant than blockchain currently regarding their operations. Can you give us a little bit of background as to why you think this is?
Yeah, I think the idea of APIs and blockchain. So not everyone's familiar with what those are. I think when we talk about APIs, application programming interfaces, the key reason why it's been developing in Treasury has to do with PSD2, the Payment Services Directive 2, that European regulation or standard that requires banks.
And this is known as open banking, right? It's been given the definition or the term open banking in the environment.
Yeah, I think that's a good term for it because it's banks have these big legacy systems that's hard to get data out of, and so we're used to things like secure file transfer protocol, where it's you set up this whole roundabout way of pulling files out of the banks and using or consuming them, whereas an API is a program or utility that can quickly query and receive a response. So this requires banks to put a front end that can provide that quick response in a secure manner and in an open way, right? It doesn't require this giant structure to pull data in and out. So it's great for tech firms. It's great for companies that are looking to gain data that may have different types of accounting or finance systems and need to pull this in. So it allows easier access than the old, the currently available services like file transfers.
Why do you think PSD2 is pushing such widespread availability and application of APIs?
Yeah, for some people love regulations and some people don't like them. It's certainly the case when certain regulations come into effect they drive behavior. It makes it available, right? The competitive nature of people clamoring for APIs may not have been as strong, except from some companies. But when it becomes put in place as a mandate, then it's available and everyone has access to it. And I think we've seen that in Europe. They said this is a good way to go, a great way to go. That's where technology is heading. Let's make this a requirement so that other developments can occur. And this provides, the infrastructure, different types of cell phone communication protocol. Once that's put in place, people can, share more data, pass more information on. This has happened here on the API side, starting in Europe, but it's spreading to other areas as well because it's good technology, it's useful, and it helps.
It's streamlined and efficient. Yes, absolutely.
Very much.
So now going to the other side of that coin, and just to give our audience some perspective, over 4 times as many corporates selected APIs as being more important than blockchain at this point in time. So do you think that blockchain is just less important overall, or just the fact that APIs are seeing widespread adoption right now is what's driving that importance over blockchain?
So let me start with a little bit of background on the 4 times number. So 39% thought APIs were more important, whereas 9% chose blockchain, and that's where it's 4 times. But think about those two things together. Just over half weren't sure. So there's a lot of people who aren't familiar with what is blockchain. They hear Bitcoin, blockchain, it can get very confusing in their head. So those that knew on the corporate side, by a 4-to-1 margin, said APIs were more important. Is it more important? I think it is because it's more widely available and there's more services there. Banks like it as well. But I think the key thing is, what's useful for APIs, this idea of open banking, which you talked about, that people can access it, means it can be used more readily. It means you can develop things more quickly. Oh, I just need to see who's a signer on an account. I need to see a balance or a transaction or something that I can get at. Now I can build that in, a system I use that's not a banking system, that's not a treasury management system, that's not even an ERP, but now I can expose my new system to that data in a controlled manner without significant development costs. So now it lends itself to functionality and creativity because you can use those for more. Blockchain is useful, and when you think about how much banks have been investing in companies that do blockchain, this distributed ledger technology, DLT, there's a lot of useful applications for Treasury too. You're passing documents. You want to make sure that there's a control and support as you go back and forth. This distributed ledger where you can have independent confirmation from multiple sources that doesn't have to be a central bank or a bank, means that things can be developed more rapidly, that activity can occur. So there's use to it, and banks have, in the last couple of years, invested well over $1 billion in firms that are exploring blockchain. Now, people know blockchain. They think of Bitcoin. Bitcoin, perhaps equals blockchain in some people's minds. It's not. It's the distributed ledger technology can be applied to letters of credit, any kind of documentary collections where you're having to swap data and documents in a controlled manner. And, I think anybody who has, an example or an analogy to this is anybody who has had to sign agreements with somebody who's in a different location. How did that work? You go back and forth a bunch of times on editing the document. And then you say, when you come to agreement, you get multiple copies, you do a wet signature, you stick it in an overnight envelope, it gets mailed to the other place, they sign it with a ink pen, wet signature, then one of the copies goes back to the other area, then it gets scanned and put in a file. Days go on. Lots of steps are involved. It just slows business down. Now you have things like Right Signature or DocuSign. That back and forth can be, it goes, the document's there, the person signs it in a central repository. It's digitally captured. It knows where. It has validated emails. It captures that information. The other person signs it, and it's instantly distributed to both parties. You take days out of that process. Well, that's signing a document. There's a lot of things that are more complex with, I'm shipping to another country. There's all these steps that have to be met. I don't want to be exposed financially. Banks have always had to play the core role in that, and it was hard. So whether banks are sitting there from I'm leveraging my balance sheet, I'm leveraging my expertise in different countries or not, it can make many of these processes that are extremely cumbersome much less so. There's still validation, but it's just streamlined and more
Okay.
more expeditious.
And final question on that before we move on to the next point. When do you see blockchain really catching on within the Treasury environment? Do you see it as catching on right now? Are you seeing adoption? Or do you think in the years to come, maybe 3, 5 years out, even 10 years out, what's your perspective there?
Yeah, I mean, there are some applications of it going on now. There's a lot of pilots occurring.
And we've certainly seen Ripple, even with regards to payment operations, certainly garnering attention in the recent months.
Yeah, and that's almost understating, right? Garnering attention. I mean, just in terms of investments and what's going on, putting a challenge. You look at SWIFT as an example, right? They can validate transactions, ensure non-repudiation. You can't say I didn't send it, I didn't get it, I sent it. None of that happens because SWIFT can track those things. Well, in the same way Ripple is using this type of distributed technology, there's not an opportunity for this type of dispute. So yes, there's a significant opportunity for this to grow. It tends to be small at present, but banks are putting money in it. There are pilots out there. There's a lot of attention. So the areas where the most significant opportunity for streamlining, achieving efficiency, we'll see that. And so you can think of all these documentary collections, places where a lot of paper has to go back and forth. Are areas that are ripe for this kind of leapfrog technology.
Okay. So API seen as more important at this moment, but certainly be on the lookout for blockchain's growing focus in the years to come. Switching gears now, faster settlement versus enriched messaging. So this was with regards to payment operations. This is a question we asked corporate treasury as well as to banks, but we'll be focusing on corporates here. We're all aware of the continual drive for faster payments that's occurred within the industry ever since payments have been sent between companies. And certainly within the last couple of years, we've seen same-day ACH and real-time payments, some other faster payments networks come into the equation. But at the same time that that's occurring, there is another challenge that's impacting Treasury, and that's with difficulties relaying information within payment messaging back and forth. And when we look at, I believe we asked corporate treasurers here if they saw faster settlement as being more important or enriched messaging as being more important, and a larger proportion indicated that enriched messaging was more important. So can you give us some background information on there, why you think that is, and maybe what to look out for moving forward?
Yeah, I think that brings up a good point. Anything taken in isolation can look good in one way, but you have to look at the total package, the entire process. So if you optimize one part of a process, you can sub-optimize the whole because you don't care about the other. So if I can get my payment to you faster, but I give you no details about what I'm paying you, now your automated process of posting that payment can be broken. It's like I can't apply this to the invoices. Now I have to call you or email you. What were you paying for? Going back and forth on that. You've broken the process. You've made things faster, but you've broken the process.
But at a cost, right?
Yeah, and that cost is, everyone cares about efficiency. Cash is king, cash flow is important, but getting more people involved in exception management and errors is extremely costly. It breaks the process. It ruins relationships between trading partners. So this idea that very practical Treasury people have said, I think that more information for posting or more enriched information is more important than going from 1 day to 2 hours for a particular payment. There's always wires. So I think that's a very realistic, practical, and comprehensive view of the entire process. And it's good. It's not that you say, I want slow but good information. It's like we want it fast, but it has to be enriched so that we can do things with it.
Now, there is one specific area of this faster settlement argument that I wanted to call attention to and get your thoughts on. When you look at domestic payments, you look at same-day ACH, sure, you're going from maybe next day settlement and clearing to same day, so maybe from 24 hours to 6 hours to 4 hours, something like that. But when you look at cross-border transactions, going through the correspondent banking model, maybe where it's taken a week historically for a payment to settle, you look at faster settlement now with opportunities for a day settlement of cross-border payments. Do you see faster settlement there as being more important than better information, enriched messaging, or do you think the same principles apply?
I think I would say that it can be the difference would be less important. We didn't talk just about cross-border. We asked the question
Right.
broadly, but the same principles hold. I mean, the longer it's delayed, the more money matters, and we'll clear up the other components. But you still can't break the process when you're going overseas. And there's a number of challenges, not only with speed, but where is the payment? How many times do I have to get involved in it? So
Right.
if I can shave that down, I get less contact. So it would, you bring up a good point that it shouldn't be as much when you start dealing with, I'm reducing it from a week to a day.
Right.
And usually some of those old payment methods didn't provide much data anyway. So if you're just getting faster, the same level of information. But I think that the key point here is the reason why we're asking some of these questions when we designed this was we wanted to figure out, this versus that, not just general perceptions, but also some of, comparing something directly to another part.
Right.
And this idea of payments, we use the term faster all the time, and I think the concept is better. What's a better payment? One that has more information you can use, it arrives more quickly, you know what it costs, and you can see it in transition or, as it's being transported through the banking system. That's that's more than the trifecta of results. It addresses all of the needs that people care about in cash application, in Treasury, customer service, relationship management. All those things can be met when we think of them as better payments. Better payments address these needs.
So this next data point that we'll be discussing was with regards to the SaaS-based cloud platforms. And this was one that I found particularly interesting because, well, just to give our audience the context, we asked corporates what types of technologies they saw as having the greatest impact on their functions and their payments in the next 2 to 3 years. And we provided a range of options. We provided cloud platforms, DLT and blockchain, robotic process automation, artificial intelligence, and so on and so forth. And out of all these different options, cloud platforms and SaaS-based technologies were seen as the biggest disruptor, despite having been around for well over a decade at this point. Your thoughts?
Well, I think there's this idea that when new technology comes out and it starts to hit the street, we project things. We think things are going to happen in a period of months, like the transformation is going to occur in, weeks or days, and it takes multiple years. So when I think about cloud platforms that are finance specific, banks moved from the installed software, early 2000s to, private cloud, and then to the internet to provide support and updates. And so that took off there. In the treasury management system space, SaaS or that type of delivery dominated sales starting in 2006. The majority of sales happened there. Well, it takes a long time to work through the
Right.
the system.
And even if you adopted an installed solution in 2005 and then SaaS-based solutions became the norm in 2006, you may still even have a decade, 10 to 12 years before a technology systems overhaul became necessary. And at that point, it is 10, 12 years down the road. And now you're looking at a SaaS-based solution, but it's been a long time since the original introduction.
You bring up a good example. I mean, we worked with a company about 8 years ago and looked at some technology, a system that had not been supported, and had recommended that they upgrade to something that is supported. That is, there was only just patches being put on the system. No real development occurred for like 5 years prior to that. Well, in that intervening time, the vendor finally said, we're no longer going to provide any support or any patches. And so now we're back in there taking that technology out, putting some new technology in. So things can last for 20 or 25 years, as 3 or 4 cycles of management in an area. So cloud specific. People are very comfortable with cloud now. I mean, everyone uses multiple applications where stuff's stored in the cloud. The security concerns, that were originally the big issue have long been put to rest. You have concerns whether they're installed or you're using SaaS. So people are more familiar with it. So that's why I think more feel that that's going to be the biggest disruptor, because you keep moving stuff out of premises on into the cloud.
Right.
It's faster, it's easier to support. You don't have to worry about all the headaches and hardware.
Yeah, that makes sense. And just for additional perspective, in our 2017 Treasury Technology Survey, we've seen that it's just been within the past several years that the iceberg has tipped over, so to speak, that more companies have adopted SaaS solutions than those that have installed solutions in place. I believe it's about 40-60 at this point, 60% SaaS solutions, 40% installed. So despite having been around now for more than a decade, it's just now beginning to become the majority.
Yeah, that's a interesting thing to think about, for the audience who's listening. The number of new sales for SaaS passed installed solutions in Treasury systems in 2006. That's when it passed. So we're 12 years into the future now. And so when you look at the larger companies, or companies $1 billion in turnover, what system are they using? Well, SaaS has surpassed installed in that group. So many of these had them in place before. They had the money, the time, the manpower to put in those bigger systems and support them. Well, they don't just rip them out every 2 or 3 years. When you look at the smaller companies under $1 billion, that technology was always out of reach. Well, almost all new systems are going in as SaaS, and they're able to manage those and take advantage of technology that was only available to the largest companies. Now it's available to the smaller companies. It's better, it's cheaper, and it's more scalable. So you move from this process of I buy something and it decreases in value over time, because I have to support it, I have to put patches on, I choose not to put a patch on, choose not to put another patch on, and I get to the point I have to upgrade it. Whereas now, every time I add value to the system, I can do more things with it. Now the system is worth more to me. The vendor is updating it so it continues to increase in possible functionality. So it's two very different models, one of declining value and one of increasing value. That's significant. And so we've reached the installed base inflection point on larger items, and it's not going to change. It's going to continue.
Yeah, thanks for making that point. Now, moving forward to something that maybe many consumers are taking advantage of at the moment, maybe not a technology that has been as readily adopted in the commercial space. We are talking about mobile banking. So, despite bank enthusiasm, and we have seen a significant amount of bank enthusiasm over the past several years regarding commercial mobile banking applications, but then when you turn to the corporate side, we ask them about how mobile banking applications are impacting their business plans, their model. The majority don't see them as all that important, and this may be something that's surprising to banks. Can you give a little insight as to why you think that is?
Yeah, I think banks serve a range of customers, and the customer's needs are very different, whether the customer is an individual person, a single owner company, or a global multinational bank. Their needs are very different. So if you're an individual, hey, it's great that I can take a picture with my phone of a check and deposit it. It's wonderful that I can move money. I just have to get that multi-factor authentication. It sends me a code to the same phone I'm using. I can move money, make decisions, request, whatever I need to do through that. Highly functional, very easy to do. That's what a consumer cares about. And it's, and we're used to that. And, younger people who are becoming adults and using things expect that, right? Not just there's a sense of I'm impatient, I want everything. And there's a sense of we have technology to deliver that. Now, when you look at what a business needs, you need, multiple users to approve something, right? You have to have dual authorization to move funds. You're not concerned about the $2,500 limit the bank may place on a movement through Zelle, through your banking platform. You need to move, $50 million. Well, that single authentication or a single user doesn't work that way. You can't have your credentials compromised and you lose $50 million. That does not work. It's a very different world. And so, I think that the consumer side, people get excited about what's going on the consumer side.
Right.
And both those areas talk in the banks and say, like, hey, we're doing this. We need this for the platform. It's great. And people think all of that stuff bleeds over to the corporate side, and it doesn't. There's different needs. And so we run into the situation where the bankers get way more enthusiastic about mobile than the seasoned treasury
their
people.
Corporate clients, right?
Yeah.
And you have already touched on this in your discussion just now, but I wanted to emphasize it a bit more clearly. What do you think the biggest obstacle to mobile, I guess you could say, mobile banking adoption is on the corporate side, And do you ever see it's catching on or becoming popular?
Well, we see such a large percentage of companies that don't allow your own device for that. Now, it's one thing if you have your laptop and it has all the security controls. You VPN into the corporate network. You're in a secure tunnel. You're doing those transactions. That's not so different from what you're doing if you're in the office doing it. So that's not what we're talking about here. It's like doing mobile on your phone, maybe on your personal device. Yes, more people are doing it. It's one thing to say I got an email or an alert or a notification that says go approve a wire or do something. I think I don't know that it's ever going to get to the point where people are like, yeah, we're really comfortable initiating wire transfers from the system. It's one thing to approve a wire transfer, maybe not as concerning
or even just to receive transaction alerts or something along those lines. Yeah, the
transaction
basic
alerts, perfectly fine. I'm going to see this. I need to acknowledge it. Now I need to go to a secure location to do this type of banking. That certainly seems like it's going to be the norm for a while. Phones are easily compromised. They continue to work out security. You can look at some apps that provide encryption of data for PII, et cetera. But it's a much harder challenge, a more significant challenge to make that easy. And quite frankly, it's a lot faster to type on your laptop than to punch a whole bunch of banking information on a phone. And so the people that are doing that are usually, they have mobile laptops and they can do it. So
okay. Now our final point of this discussion will focus on forecasting. So, as any treasurer probably is aware, forecasting can be a source of significant headache, also a very time-consuming process, depending on the type of technology used. And the insight that we've derived with regards to forecasting in this survey was that it remains sort of an inefficient process, despite, honestly, a lot of innovation in the space that's occurred over the past 5-6 years. Could you give us some insight regarding, first off, what you've seen with regards to the updates that solutions providers have brought forth in the forecasting realm, and then what some of the challenges that continue to haunt treasurers are?
Yeah, I think there's a couple things when I think about forecasting. We used to always say, forecasting is a bridesmaid, never a bride. It was always very important, but not the most important thing in Treasury. Well, the last few years, it seems like forecasting has become increasingly important to the entire range of companies, not just those who are on the margin. You get close to insolvency or things are really tight with your credit. You get really good at forecasting. Well, we see most organizations are spending quite a bit of time on that. And when we looked at, where are Treasury people spending most of your time, I did not expect cash forecasting to resonate with 32% of the respondents. That's almost triple the next highest, which was payment management, and then risk management at 11%. So this was a bit eye-opening to me. I mean, we're in companies all the time. They're focused on forecasting, cash movement, risk management, et cetera. For people to say, this is where I spend the most of my time, very interesting. And there's some differences by types of roles, right? The treasurer is not spending the most of the time on that. Sure. And we have a large number of treasury managers who are doing that. It's still very important to understand where your flows are. The more you can know with confidence where things are, the easier it is to forecast. The easier, that's the same definition, right? The easier it is, the better you are at forecasting, the easier it is to earn higher yield on your investments. The lower rates you get for borrowing, the more confidence the market has, the more you can address your concerns and not leave as much margin out there, so you can be more efficient. That efficiency is pretty crucial. You asked a question about the technology as well.
Right, and that was just despite a lot of innovation that's occurring within the forecasting solutions available on the market, there appears to still be a lot of headache for Treasury regarding the application of such solutions. Why do you think that is? Have you seen any examples of this that you could elaborate upon here?
Yeah, so I think one of the challenges with forecasting is that there are multiple types of forecasting, and those that are in Treasury or in FP&A know what their forecasts are. Executive management may or may not understand the differences. That forecast is a forecast, right? It's the same word. Why Why are the numbers so different? And what's the purpose? When you think about what the cause is. So, an FP&A forecast is what? Large time buckets. We want to see well into the future. And we're focused on the income statement. What's our margin going to be? What's our income going to be? That's what the FP&A forecast is about. It's not about, cash flow. It's not about the balance sheet, which Treasury is focused on. Treasury has two types of forecasts. The short-term forecast, usually a year or less, sometimes 6 months in. And this is about liquidity planning. How am I going to make my needs? Do I have the cash in the right accounts, in the right currencies at the right time? That type of thing. And then Treasury also looks at, their balance sheet planning, their capital planning. What does our balance sheet need to look like 2 years, 3 years, or 4 years down the road to meet the organizational objectives? So they have to look at those things from a balance sheet perspective. FP&A is focused on the income statement. And it's easy to say, just run the routines that say, convert this income statement projection to a balance sheet projection. And it's much easier to say, and it's easy to hit the button. It doesn't always translate the same way. So if someone moves they plan to do a CapEx spend in March, they move it out 3 months. Well, it doesn't impact their income statement that much because it's a 8-year depreciating asset or a 10-year depreciating asset. Very minimal impact. 1/120th of the purchase cost gets moved out from their income statement. Well, that $10 million spend no longer occurs in March. It now occurs in May. Well, that's a $10 million swing in your March forecast as well as your May forecast. Very significant difference versus the FP&A spend. And people may not see differences like that. So the challenge is, I think the challenge of a forecast is there's different types of forecasts. Here's the operating forecast for whatever the flows of the business are. Ice cream sales, insurance premium, claims payments, disbursements for raw materials for manufacturers, whatever those things are, there's an operating flow. There's also the capital flow that Treasury is usually really good at because they see it. So there's different elements of that. And I think the pieces that can cause consternation is some of it has to do with communication, not just system communication, but tax all of a sudden has a $5 million tax payment they tell you about in the morning, and Treasury didn't know what it was going to be. Last year was $1 million, and then there's a surprise payment that has to be done, or legal, there's a closing deal and nobody told you about it till the day before, so nobody puddled up the money to have it. Those communication things can be an issue, not just solved by IT, but solved by a communication, report these significant events. Other information can be reported technically. But I think one aspect of the forecast, or a couple aspects of the forecasting that sometimes people think about in terms of risk. They think of, here's my expected value, what the one number is versus a range, cash flow at risk or earnings at risk. Sometimes people think, this is what the expected value is, what I'm going to get. Just like rolling the dice, you roll 2 dice, what are you going to get? You're going to get 2 to 12, right? The expected value is 7. Well, but there's a pretty significant range. And same thing with earnings and cash flow. Same things with sales projections. They can differ. So if people think everything is consistent, like some lines of business or some companies are, it's like same as last year plus 2%, very consistent, easy to forecast, sitting in your cube or in your open workspace in Treasury based on bank data. It's like, perfect. There are other flows that are very hard to, new business areas, very hard to forecast. You have to get outside your space. You have to talk to people. And I think those are some things people have to realize. What are you forecasting and how is it going to behave and what's the best way to do that? And then finally that process, and this is to your key point there, Isaac, about the using technology has to do with what I would call variance analysis. And we all know the phrase, what gets measured, gets improved or gets done, et cetera. So those types of thinking is important. So if you have a forecast and it's different, how are you going to learn from that difference? So you can say, it's a difference, what it is, and we move on. Or do you say, here's the difference, what's the cause of that? Is it a one-time event or something changes? Is there a secular change in our business model? Is there a specific event? Is there a communication breakdown? Does that influence what I do in the future? Now, when people look at that and say, how do I do that variance analysis? If it's manual, it's only when it's very significant, people run around and make the statement and maybe not fix the underlying issue. When you have a systematic process of being able to run and see those variances, pinpoint where, oh, we're forecasting in the wrong country, in the wrong currency, in the wrong account, on the wrong week, on the wrong day of the week. Whatever those are, people can pin it down. And now the forecast starts getting tighter and tighter and very good without involving an army of people or without, being the area that you spend the most of your time on. So I think that's crucial. I think the other piece that's good is, forecasting in Excel is wonderful. You run your forecast. It's a little harder to do variance analysis, and it tends to be a little bit harder to do variance analysis on multiple models. So when you have something like a TMS, I can create, many of them allow you to create multiple models of a forecast. And you can compare what happened to that, currently, historically. So you create a new model and say, which one's performing better? Where are those differences? And then you can improve on your model and your overall forecast without depending on just, there's a massive disbursement that occurred after Thanksgiving. Why? You're able to back test things simply that you couldn't do before. So some of those functions give Treasury the tools to do that. Not everyone's taking advantage of them, but there's a lot more in the tools. I think that holds a lot of promise for those that are focused on forecasting.
Right. Okay. So, in viewing all of these results in aggregate, we've covered APIs, blockchain, faster payments, et cetera, the rise of SaaS-based solutions. What are some key takeaways, some key findings that you've seen holistically or comprehensively as you look at these?
Well, I think there's no shortage of new technologies, new trends. These are exciting. We didn't even really get into AI, machine learning, or business process automation.
Right, some of the more exciting things on the cusp right now.
Yeah, some of the things are great for webinars, and sometimes people say these are not real, and then you say, oh yeah, they are real in certain areas. Some people are testing. They're in different stages. I think the key thing, the one theme to take away from this is to stay current about what's happening and have some sense of calibration of this is just an early idea. This is being tested and piloted, and this is working in some applications in Treasury or Finance. Or it's working in other areas that has an application.
Sort of separating the buzzwords from those areas that are actually having or displaying real value at this point in time.
Yeah, getting too caught up in the hype or too dismissive of the technology. Those are two ditches on the sides of the road. It's funny how people are like, oh, this is great. Bitcoin is going to dominate the world, and, Treasury will just use Bitcoin. You could say, okay, that's pretty much nonsense. But when you say, hey, there's different types of technology with distributed ledger, here's where I could really remove significant impediments. Now there's some interest. Here's technology that allows me to see my bank accounts from all over the globe, or I can now have visibility into payments that I send anywhere, and I can see that at any point in time. Now you've taken away massive obstacles and impediments that didn't exist before. So staying current with what's happening and being able to calibrate that to see, is this testing, it's a pilot, et cetera. And the other thing, and another way to do that is to look at what's coming out when you look at some of these, like the Alexander Hamilton Awards or the Adam Smith Awards, where people are submitting what they've been doing. So there's always leaders, right? That everything doesn't come out all at once. There's some leaders who are taking advantage of technology, new processes, new structures. So looking at what comes out there is a good indication of, does this have legs for the rest of the universe or for particular applications in Treasury? And I think if you do that, you can categorize, what's hot this year, next year, the year after, by systematically staying in touch with it. And as always, be practical. You can't, being practical means it's got to make sense today. It has to address my current needs. And if you do that, I think you're going to be in much, much better stead.
Excellent. Thank you so much for sharing those insights, Craig. That concludes our discussion for today. I would encourage anyone who would like to find out more about the Treasury Perspective Survey, any components of the technologies we just discussed, to download the Treasury Perspective Survey report or view the webinar presentation. Both of those items can be found on our website, strategictreasurer.com. Thank you so much for joining us, and we'll see you next time.